Hello, my name is Patricia Au, Assistant Senior Manager at the Australian Accounting Standards Board, the AASB.
And I'm Jim Paul, a consultant at the AASB.
Welcome to the webcast's Introduction to Exposure Draft ED320, Fair Value Measurement of Non-Financial Assets of Not-for-Profit Public Sector Entities, which the Board has recently published. Thank you for joining us today. Please note, the contents of this webcast have been prepared by staff for general information only and do not constitute advice. The Board disclaims all liability for any loss or damages arising from reliance upon any information in this webcast. Today, Jim and I will provide an overview of the proposals in ED320. We will also provide information about how you can register for one of the virtual roundtable discussion events in May. The purpose of this webcast is to summarize the proposals in ED320 to facilitate your input to the board. Let's begin by looking at the objective of ED320. The board's objective is to add authoritative implementation guidance to the AASB 13 fair value measurements. To assist fair value measurements of non-financial assets of not-for-profit public sector entities that are not held primarily for their ability to generate net cash inflows. That is, assets held primarily for their service potential. The aim is to provide guidance on the market placement assumptions to use, the assets' highest and best use, and the application of the cost approach when measuring the fair value of assets that are not held primarily for their ability to generate net cash inflows. Such assets are simply called assets or public sector assets for the purpose of this webcast. In terms of the scope, ED320 proposes that the authoritative implementation guidance should be applicable only to not-for-profit entities in the public sector. This is because the proposed guidance was developed in response to requests from public sector stakeholders, and that the board was informed that revaluations of non-financial assets are more pervasive in the public sector than in the not-for-profit private sector. However, the board would like to know your views on whether it would be appropriate for the guidance to apply also to not-for-profit entities in the private sector. Please let us know your reasons for your views in your submission to the board. Let's now look at why stakeholders have requested for guidance on the market participant assumptions and the highest and best use concepts. Those two concepts are fundamental to the fair value measurements of an asset. The AASB 13 states that fair value measurements of a non-financial asset takes into account a market participant's ability to generate economic benefits by using the assets in its highest and best use, or by selling it to another market participant that would use the assets in its highest and best use. Stakeholders have provided comments to the board that many public sector assets provide services that are unique to the holder of the assets, and therefore it is unlikely to have an identifiable market participant other than the holder of the assets. Because these assets are rarely sold, it is also unlikely for the market selling price of these assets to be directly observable. Those stakeholders are of the view that such assets are unlikely to be used for another purpose, and therefore consider that the asset's current use would be its highest and best use. In light of those comments, the board decided to provide guidance to assist not-for-profit public sector entities apply the market participant assumptions and the highest and best use concepts. In developing guidance on market participant assumptions, the board noted that the AASB 13 specifies that an entity need not identify who are the market participants for the assets subject to measurements. that is, the subject assets. The standard requires that an entity maximize the use of relevant observable inputs and minimize the use of unobservable inputs in applying measurement techniques. The board observed that when measuring the fair value of public sector assets, some unobservable inputs would often be necessary when another identifiable market participant for the assets is unlikely to exist. For example, where the asset is specialized to provide services that are unique to the holder. Consequently, the board decided to provide guidance on the market participant assumptions to use when developing unobservable inputs. Paragraphs F4 to F7 of ED 320 proposes that the entity, when developing unobservable inputs, would use its own assumptions as a starting point and adjust those assumptions if reasonably available information indicates that other market participants would use different data. If no relevant information about assumptions of other market participants is reasonably available, the entity would use its own data in developing unobservable inputs. The goals of that proposal are to re-express the guidance in paragraph 89 of the AASB 13 to permit the use of the entity's own data in developing unobservable inputs without needing to incur exhaustive efforts to identify other market participant data. This would clarify when a search for assumptions of other market participants ends, and consequently reduce the costs and effort required to identify which market participant assumptions to use when measuring the fair value of public sector assets. We particularly want to know whether you would agree with this proposal. Please come and share your views at one of the roundtable discussions. Let's move on to the guidance on an asset's has and best use. The AASB 13 paragraph 29 states that an entity's current use of a non-financial asset is presumed to be its has and best use, unless markets or other factors suggest that a different use by market participants would maximize the value of the asset. However, some stakeholders consider an alternative use to the asset's current use would rarely exist for many public sector assets because often those assets are specialized in nature. Those stakeholders commented that it would be beneficial to have additional guidance regarding the has and best use of public sector assets to avoid incurring the costs of considering whether the market or other factors referred to in paragraph 29 might exist. The board considered comments and decided to propose guidance in ED 320, paragraphs F9 to F11, that the presumption in paragraph 29 that an asset's current use is its has and best use is rebutted only when there is evidence that the appropriate level of the entity's management is committed at the measurement date to a plan to sell the assets or use the assets for an alternative purpose. We would like to know whether you agree with this proposed guidance. Please come and share your views at one of the roundtable events.
Next, I will provide an overview of the proposed guidance regarding the application of the cost approach. The cost approach is applied extensively in the not-for-profit public sector, and stakeholders have requested the board to provide guidance to assist entities in the sector in calculating the current replacement cost of assets. AASB 13 does not specify whether fair value measurements under the cost approach should assume continued use of the asset in its existing location. A practice issue the AASB was asked to provide guidance on is whether an item of real property should be assumed to be replaced in the most economical manner and therefore assumed to be replaced in a cheaper location if the services can be delivered in a cheaper location. Stakeholders expressed concerns about the cost, complexity and auditability of choosing from a potentially large range of alternative locations. ED 320 proposes guidance that it should be assumed the asset would be replaced in its existing location, even if it would be feasible to replace the property in a cheaper location. The board reached this view because, firstly, location is an intrinsic aspect of an asset's amenity. Secondly, properties in a cheaper location have a lower residual value that could be reinvested in other assets' service capacity. And thirdly, for many properties, there might be a variety of possible alternative locations with different market prices, making it difficult to reliably value the asset in its assumed alternative location and costly to perform multiple valuations. We would like to know whether you would agree that, under the cost approach, it should be assumed that the asset would be replaced in its existing location. AASB 13 does not specify the nature of the component costs to include when calculating an asset's current replacement cost. Stakeholders requested guidance to clarify the types of costs to include when calculating an asset's current replacement cost, particularly for a self-constructed asset, which is not acquired in a single transaction. In paragraphs F14B and F14C of ED 320, general principles are set out that an entity should assume that the subject asset presently does not exist and all components of the asset need to be replaced based on its existing service capacity at the measurement date. Thus, all necessary costs intrinsically linked to acquiring or constructing the subject asset at the measurement date are included in the asset's current replacement cost. The proposed assumption that the asset presently does not exist and needs to be replaced in full is consistent with the AASB's basis for conclusions on International Financial Reporting Standard, IFRS 13, which states that the definition of fair value in IFRS 13 assumes a hypothetical exchange transaction. The process of determining current replacement cost is set out pictorially at the bottom of the slide, indicating that the current replacement cost of the subject asset, you start with the estimated cost of a replacement asset, which might be either a modern equivalent asset or a replica asset, and then adjust for differences between the service capacity of the reference asset and the subject asset. In this context, a modern equivalent asset is an asset that provides similar function and equivalent utility to the asset being valued, but which is of a current design and constructed using current cost-effective materials and techniques. Because all necessary costs intrinsically linked to acquiring or constructing the subject asset are included in the asset's current replacement cost under the proposals in ED 320, paragraph F15A of that exposure draft proposes that once-only costs are included in the asset's current replacement cost. And what are once-only costs? They are costs of parts of an asset not expected to actually be replaced in the future, and this is because they are not expected to wear out during the asset's economic life. This proposal is consistent with the exchange transaction in fair value being a hypothetical transaction based on current market conditions. In addition to once-only costs, paragraph F15B of ED 320 proposes that an entity determines, based on its circumstances, whether, in a hypothetical transaction, necessary costs intrinsically linked to acquiring or constructing the subject asset would include, firstly, costs of removal and disposal of any unwanted existing structures on land, and secondly, disruption costs. And disruption costs include costs to restore an asset not controlled by the consolidated group, if any, to which the entity belongs. Now, Let's look at two examples of how an entity would apply the proposals for identifying the component costs to include when calculating an asset's current replacement cost. This slide provides an extract from ED320's illustrative example 1 regarding the nature of the component costs to include in an asset's current replacement cost. It illustrates Council A, which controls a road. The following costs relate to that road and are measured using prices as at that measurement date. The example illustrates the proposed guidance in paragraphs F14 and F15. Each of the estimated costs listed in this slide, which total $23,200,000, should be included in the road's current replacement cost. Current replacement cost assumes that the road asset presently does not exist and all components of the road, including the once-only earthworks and formation works, would need to be replaced in a hypothetical replacement of the road at the measurement date. This is because, from a fair value perspective, the cost to a market participant buyer to acquire or construct a substitute road of comparable utility at the asset's existing location would include each of those costs, including any intrinsically linked disruption costs, for example, traffic control and detour costs. Another assumed fact in the fact pattern for illustrative example 1 is that Council A's road is situated in a densely populated area and there are no vacant sites in the surrounding area. To construct the road in a hypothetical acquisition, a market participant buyer would need to incur $1 million to remove and dispose of unwanted structures on the land. Council A includes the $1 million estimated costs of removal and disposal of the unwanted existing structures in the road's current replacement cost. This is because it is reasonable to expect that a market participant buyer would need to incur such costs if it was to construct a substitute road at the subject asset's existing location, since there is no vacant land available in the area. Thus, the total amount of the road's current replacement cost in this example would be $24,200,000. Illustrative example 2 builds on the first illustrative example. It assumes one change in circumstances for Council A for the next reporting period to that in illustrative example 1. Specifically, it assumes that if the road was to be replaced at the measurement date, drainage works under the road that belong to another entity would be disrupted. The current cost required to restore those drainage works is assumed to be $2,500,000. Council A includes in the road's current replacement cost the $2,500,000 restoration costs. However, those restoration costs would be excluded from the road's current replacement cost if the drainage works were controlled by the consolidated group, if any, to which Council A belongs. This is to avoid double counting those costs in the group's financial statements. This situation would seem unlikely in the local government environment. ED 320 paragraph F15C proposes that an entity calculates an asset's current replacement cost based on the entity's expected manner of replacement in the ordinary course of operations, rather than the theoretically cheapest legally permitted costs to the entity. For example, replacement of a road surface might necessarily, in the ordinary course of operations, occur at night rather than during daytime to minimise disruption to drivers. If so, the more costly nighttime costs should be included in the asset's current replacement cost rather than the lower daytime costs. We would like to hear your views on the nature of component costs to include in an asset's current replacement cost. Another issue on which stakeholders sought application guidance for AASB 13 Specifically, paragraph B9 is how economic obsolescence should be identified in measuring an asset's fair value under the cost approach. In a not-for-profit public sector context, economic obsolescence can be regarded as a decline in demand for the services the asset provides. The board decided that economic obsolescence should not be identified if the asset has apparent excess capacity that is in fact necessary for standby or safety purposes. And economic obsolescence should not be limited to circumstances in which a formal decision has been made to reduce the asset's physical capacity. For example, a public school building has capacity for 500 students, but due to demographic changes, a school for 400 students would meet current requirements. The government expects that the demand for the school services will increase to 500 students within the next 3 years as a result of a planned nearby infrastructure project. The excess capacity for 100 students represents standby capacity of the school building and, therefore, would not be identified as giving rise to economic obsolescence. However, if a public school building has capacity for 500 students, but due to demographic changes, a building for 100 students would meet current and reasonably foreseeable requirements, the school building's gross replacement cost would be based on the needed capacity for 100 students. This would be the case regardless of whether a formal decision has been made to reduce the school's capacity. We would like to know whether you agree with the board's view on when economic obsolescence should be identified.
Let's now look at the proposed transition requirements and the effective dates. The board proposes for the authoritative implementation guidance to be applied prospectively for annual periods beginning on or after 1st January 2024, with early application permitted. As mentioned throughout this webcast, your input is very important to us. Please consider attending one of the virtual roundtable discussions in May and/or provide written comments to the board on the proposals. We will be hosting 3 virtual roundtables by group jurisdictions. This is to assist in identifying shared jurisdiction-specific issues or concerns regarding fair value measurements and to achieve an even spread of participants across the 3 events. If the event covering your jurisdiction is at an inconvenient time, please feel free to register for one of the other 2 events. The first roundtable will be held on Tuesday, 24th of May, for Commonwealth public sector entities and entities in New South Wales and ACT. The second roundtable will be held on Wednesday, the 25th of May, for entities in Victoria, Queensland, and Tasmania. The third roundtable will be held on Thursday, the 26th of May, for entities in Western Australia, South Australia, and Northern Territory. The registration details can be found on our upcoming events page, and any written comments on ED320 should be submitted by Thursday, the 30th of June. This is the end of the webcast. Thank you for listening. We look forward to discussing the proposals with you in one of the roundtable events.